Hey everyone, welcome back to the next session for the 2022 SOFA Summit. I'm pleased to introduce our upcoming speaker, Ramez with the IRA Club. Ramez, how you doing?
Mark, can you believe it's been 3 years? 3 years. This is your third SOFA Summit. I'm really impressed and proud of Memphis, everything that you guys have accomplished. Our 4-year relationship, going close to our 4-year relationship. It's been smooth and super happy with everything that's going on with both parties. IRA Club has definitely thrived after this pandemic. And we're going to get into the reasons why in a split second.
I love that. Yeah, it's all about relationships in this game, that's for sure. So one of the biggest bottlenecks and biggest hurdles that our investors ask us on a daily basis is how can we find more capital and get access to more capital so we can acquire more properties and scale and grow our rental portfolio. And one of the biggest misconceptions and one of the best places to access that capital is sitting right in front of most Americans, utilizing your retirement funds, your IRAs, your 401ks. And there's a lot of misinformation, misconceptions about the 401k, about the retirement IRA industry. And a lot of that education is flawed. Once you actually look at the numbers, look at the data. And that's exactly what Ramez and the IRA company is going to teach you, is how you can actually take control of that capital, of that money, and utilize it in a better form to get a higher return at the end of the day. And so, Ramez, why don't you take it away?
As I'm jumping on the screen, you said a word, and that word is control. And that is what we're ultimately here to try to educate, not just IRA Club members, but everybody that does have a retirement account, is the power of a self-directed IRA. And just before I jump into that, Mark, a little bit about myself. Ramez Fakhoury, Vice President. I've been here for 8+ years. My wife has been here for 10+ years. Started by Dennis Blitz, 2008. Very well-respected man within our industry. Just a little bit about our company overview and who we are. We've been around again for 15 years. We administer just under 12,000 IRA Club members. We manage $1 billion in assets. We have 35 full-time employees. But to learn a little bit more about who is IRA Club, because again, Mark said this to the T, is like people just do not understand, or may have heard of a self-directed IRA, but just don't understand it. And what are the rules and regulations behind them? And within our industry, self-direction is a marketing term that we use. All right. Self-direction, I'm going to say this over and over again, is about one thing and one thing only: control. So our vision is to always educate our clients. One of the reasons why I love Mark and his team at Memphis, education is one of their forefronts. It's one of our foundation pillars here at the IRA Club. And then our mission is just to open doors and opportunities, right? To educate, inspire. And that is all we're ultimately here to do, because this bothers me. Mark, I know you've seen this chart once before, and it hasn't gotten any better. All right. If there's 64 million IRA accounts across the country, of which, better yet, 60 million have $1 million or less, and only 1.8 million IRA accounts have $1 million or more, I always ask this question: what is the 1.8 million accounts doing right that the other 60 million accounts are doing wrong? And the answer is so simple: they're self-directing. That's it. Okay. And the other thing you need to understand is you cannot save your way to retirement. You have to invest your way to retirement. So how can you close that gap is the question. And that's what we're here to educate you on, right? But understanding the individual retirement account and how it came to fruition is just as important. All right. And my personal opinion, Mark said this: how did it get hijacked, and who hijacked it is the ultimate question. So established September 2nd, 1974, it was really, in the beginning, Congress used it to address pensions. Less and less companies were offering these, even back in 1974. So what ended up happening was, what do we do? How do we address this? They created an IRA, a way to grow your retirement account, tax-free or tax-deferred, if you utilized it for investing purposes only. However, it wasn't until later that they realized that pretty much every government program that we have for Medicare, Social Security, and Medicaid is completely broken, right? Just last year, $2.2 trillion was part of the bailout or the stimulus package that the government had to do because of the pandemic. Today, it doesn't get any better, right? So we're looking at the average IRA or 401k or 403b, I'm talking about all qualified retirement accounts, only have $40,000. Now, obviously that grows as each decade goes by, but most people are dependent on their social security checks, which is only $1,500. After taxes, you're looking at about somewhere about $1,250 to $13, depending on where you live. So the funny thing to me is, can you live off of that? And most people this day and age, especially where inflation's at, cannot live off of $1,250. Now, to add more fuel to the fire, if you take a look at when Social Security was first established in 1935, there were 24 workers for every one retiree. That number today is 2 to 1. They estimate by 2030, that's going to be 1 to 1. So there's going to be some major changes happening within Social Security within our lifetime. Otherwise, you could forget about it. Not to mention 28% of Americans over the age of 55 don't even have a savings or retirement account. This is where the majority of the US wealth within retirement accounts sits. It's within the Gen X's and the baby boomers. If you take a look at millennials, 4.6%.
Millennials.
Good job, Mark. Great job, Mark. Way to contribute. But I know that you're not that person because I actually see your contributions. So good for you, good, and the family. And by the way, congratulations on the baby. We'll talk about that later because you need to set up a Roth IRA for your kid the day they are born.
There we go.
And we'll get into that another day. But for now, let's get back into it. Adding icing to the cake, taxes and inflation. We all, none of us need to be living underneath a rock to know where inflation is. In fact, the report just came out for the month of July at 8.5%. That's not that big of a help. Finally, yes, fine. It is cooling off. It took three interest rate hikes by the feds, but my personal opinion, too little, too late. Inflation's here to stay. It isn't going anywhere. We put $13 trillion into the economy. Fun fact, Mark, did you know all wars in the US have tallied up to $11 trillion? All wars since the United States has came to existence is 11 trillion. So we printed more money these last 2 years than all wars combined. I mentioned where CPA is at. The cost of living across the board has gotten much worse for everybody. I mentioned the average household income is just north of $500 per month. That's $6,000 more per year. You need to figure out ways how to benefit or better yet, excel or accelerate your growth because it hasn't matched with the labor. I believe also at 6% across the country has been the general growth or what they've seen. But again, if inflation's at 8.5%, you're still in the hole. So if inflation's here to stay, what do? You got to use it to your advantage, right? And the way to do so is self-direction. You have to ride the inflation wave. And to do this, it's through diversification, right? You cannot have that mindset anymore of set it and forget it for the next decade. Because again, most economists are thinking inflation for the next even 5 years is going to hover somewhere between 5 to 6%. So with that being said, that's the way to ride it is the alternative space, hard tangible assets, such as a house on 123 Green Street. Taxes. Now, we're heading into a tax storm. I hope everybody realizes this because for the first time ever, the Biden administration and the Treasury Department are in full support of each other. But as investors, we need to be aware of this, right? We know that corporations are going to get hit the hardest. In fact, I'm pretty sure that everyone's heard in the last few days to battle inflation. They're talking about raising corporate taxes at 15%. But as an investor, somebody like me, you're talking about getting taxed 62% on my earnings. So I am looking for every possible path to defer money away from who? This man. That is the $1 million question that we receive here at IRA Club is how do you get rid of taxes? This is a strategy. Self-direction is a strategy because taxes will never be as cheap as where they are right now. That is the ultimate truth, okay? Not to mention, remember, we live in a progressive income tax driven country. it only goes in one direction. It's up. Now, I want to go back to this real quickly, Mark. And this is funny because as part of the new program that they're looking to battle inflation, the Inflation Redemption Act, it's funny because they said that they're not raising the taxes across anybody who's making over $400,000. But what are they doing? Because me and Dennis, president of IRA Club, had this funny discussion yesterday. Okay, let's go ahead and let's give, better yet, the IRS $80 billion. Let's give them an extra 87,000 IRS agents to go after who? The middle class. So although, Mark, they're not going to tax you, they're going to audit the living, excuse my French, hell out of you. So just be wary of that. But this still falls back to retirement and retirement accounts. If you know that every single thing is working against your retirement, if you know the market is at its worst start for the first 2 quarters in the history of, since 1952, I believe, or 1950. But if we're looking at that, if we know that taxes are on the rise because they have to come up with $4 trillion of gross revenue in the next 10 years, if you know that every government program is broken, okay, and inflation isn't going anywhere, you must diversify your retirement account. Dennis refers to this as the gift that keeps on giving. I refer to this as the most underutilized gift that Congress has ever given you. Remember, all retirement accounts are self-directed across the board. The benefits of retirement, self-directing your IRA or your 401k is control, taking back control to invest in what you know and understand best. You have to incorporate real estate within your retirement. Mark, what has never dropped, I believe, in the last 20 years? Rental income? Has rental income in Memphis ever dropped in 20 years or even 30 years?
It's going up, especially with inflation.
Thank you. Why is that? Because inflation works in your favor. That's fantastic. Now, you said something to me that I was blown away by when I asked you, what's the appreciation year after year in Memphis for the last decade?
For the last decade in Memphis, appreciation 6.11% year over year over year over year.
Year over year over year. So let's hear this again. 6% year after year appreciation. Inflation is now working in your favor at 8% outside of the stock market. And then you have your rental income that has never dropped. Has never dropped in the last 25 plus years. I shrug my shoulders. So who's in the driver's seat? It ain't you. Americans, only 3% self-direct. 97% of the rest of them put their money in 3 places: banks, annuities, and the stock market. All right. And in particular, when it comes to the employer's 401k or 403b, 457, you're typically looking at annuities. And we're going to get into that a little bit later. Today, Goldman Sachs, actually yesterday, I looked this up. Anybody could go Google this. The best CD rate at a 12-month span is 2.2%. I don't even want to talk about that. Nobody that is even listening to this should be looking at 2%. Annuities. I will talk a little bit about this because annuities are targeting people that are looking at retirement within the age brackets of 50 to 60. Why is that? Because you cannot touch your employer's 401k, but you can roll that over into an annuity. There are 2 different types of annuity. There's a fixed income annuity and there is a variable. We're going to talk about the fixed in particular. So I want you just to be wary of it. At the end of the day, this is educational. You do what's best for you. You do what's best for your family. The stock market, we all know where the stock market's been hovering for the last 10 years, around 8%. If you're looking at 15 years, it's about 6%. I think those numbers are a little bit skewed. But talking about annuities, their solution is real simple. You'll never have to worry about the stock market. Assuming you're the age of 55 years old, and let's just say you have $100,000 and you're thinking about retiring and you're terrified of the stock market and you've already lost your 20 or 25% and you think it's going to get worse, that is where annuities are marketing to people in that age bracket or larger institutions to roll those funds over. So you are guaranteed a 5% for the rest of your life, right? My personal opinion, these are the issues with annuities. Most people do not know this. They are the most profitable for the actual insurance agent, upfront commission based. Now, not to mention that most of them are salespeople. They don't really understand what are within these packages. Annuities are not, I repeat, not FDIC insured. God forbid something happens to the company. What happens to your retirement? Gone. They're very, I'm sorry?
Yeah, goes away.
Did you know?
Goes zero.
Did you? Oh, I'm sorry. I didn't even know if you knew that, Mark. But yeah, they're not FDIC insured, such as an IRA or 401k. But they're very high surrender charges. You're not in control. The key word is you're not in control because most annuities are still tied back into the stock market, even though they're giving you your 5%. But what's funny is they're making money on your money. That's exactly what they're doing because they know that they could hit 5% with their eyes closed. That's the truth. Well, let's take a look at the numbers real quickly. Let's just say you are 50, 55, 60, approaching retirement. You are terrified of the market, or you are over the age of 60 and you happen to roll over into a fixed income annuity. These are the payouts. So if you roll over $100,000, let's say hypothetical, we keep using the $100,000, you are guaranteed $421 for the rest of your life, assuming you live until 78 years old. Because that's the average age. I believe it's 78.8 to be exact. But the point that I'm trying to make is nobody could live off of $421, especially now. All right. We all know that, Mark. That's why you're smiling. Mm-hmm. Next, I call these the four horsemen within our industry. Fidelity, Vanguard, Schwab, TD. They control just under 70% of all retirement accounts. Of the $33 trillion, they control just under 70%. Fidelity being the forefront of this at 33% of all qualified retirement funds. And the reason why I bring this to your attention is this just bothers me right here. It's the truth. And I want people to be aware of these, that if you are tied into a 401k, right? Or better yet, not that you're also tied into a 401k, but you happen because this pandemic has changed a lot of people's lives. Just this last year, 22 million people have changed their jobs. And I would say about 78%, I believe was the number, had old employers' funds. And the majority of them were approached by Fidelity, Vanguard, and Schwab and say, hey, you could roll it over to your new employer, keep it there. We'll take care of it for you. But they are designed, 401ks, whether it's an employer's 401k or if it's just sitting there from your old employer, are designed to benefit them, not you. Told you, control is the name of the game, and they do this by creating artificial restrictions. This leaves you always misinformed, misguided, and you always lose an opportunity. Mark, I want to use you as the perfect example because that's the one thing IRA Club cannot do. We open the accounts, we fund the accounts on behalf of our clients. The only thing that we can't do is choose the investment for the investor. It defeats the purpose, right? We're talking about control. Otherwise, you could go ahead and leave it at Fidelity, Vanguard, and Schwab within the stock market, whatever the case may be, right? So with that being said, let's just say you have an investor and you educate them also on self-direction. They have a 401k plan, a couple $100,000, and you say to them, and they have, better yet, a registered investment advisor, and you test them, because I've seen you do this before. Go up to your broker and you say to them, I found a house on 123 Green Street in Memphis, and I would like to use a portion of my retirement funds. And they're always going to say, that isn't part of the portfolio. That isn't what we have within the brokerage firm. But these are other options that they have. That's the way they look at it, because at the end of the day, that's how they make money. And who's taking all of the risk? You. Always remember that. It's always you. And typically it's always within a fund portfolio, as I just mentioned. The only time that you earn money is when the market's up. That's it. Do they make money if the market is flat or down? Yes.
They do. Yep.
Yes. I need you to be aware of that. The only time you make money is if the market is up. And for every $100,000 that you traditionally have, it's typically between $2,000 to $3,000. And we're going to get into that fee structure a little bit later. But what bothers me about you taking all of the risk is not just the fact that you're taking all the risk with your money. you're adding longevity. So sorry, you're losing time. Forgive me, I meant to say time. You're losing time. So let's just hypothetical say there've been 12 recessions in the last 50 years. All right. Assuming you're 60 years old, Mark, assuming you're 60 years old, I'm so sorry, assuming you want to retire, let's backtrack a second. You want to retire at 60. And I'm just taking these recessions within our lifetime, right? You would add on, if you're approaching retirement, 1.6 years. If you happen to have a current employer's 401k during the .com or tech bubble, you would add 4.6, which means you would retire at 64.6, just for you to get back to even, because it doesn't take days, it doesn't take weeks, it doesn't take months, it takes years just to get back to even. Imagine if you took a portion of those retirement funds and invest on a house on 123 Green Street, or a house in Memphis, or a syndicate.
Exactly.
Right?
Yeah, because the fun fact about the way real estate performs during a recession, of real estate actually went up for 4 of the last 6 recessions. And that's fascinating. It actually increased in value during 4 of the last 6 recessions. And on one of those recessions where it actually went down, it only went down 1.9%. Abysmal. So we really only had one bad recession. And what was that? 2008, the Great Recession. But on the other 5, it either increased or was abysmal. And that's fun. That's power at the end of the day.
But Mark, 2008, 2009, forget about that 1-2%. What didn't drop?
Rents. There you go.
The market's got a pattern. All right. This is the longest it's ever been. This streak of 14 years is the longest. It's always between 8 to 10 years. There's always a correction within it. This is we're overdue for one, bottom line. But the point that I'm trying to make is, if you took your IRA funds, because if your IRA is buying that house, or your solo 401k is buying that house, or if you use a portion of your retirement funds to buy that house, Mark, what do you have? God forbid the house burned down.
What do you have? Insurance.
Thank you.
Yeah.
Insurance. So how long does it take for you to get your money back within, if you have insurance, homeowners insurance? 30, 60 days?
Go through that whole policy. Yeah. A couple of months.
Versus
you get
years.
Back, you could get paid back in full. Yeah.
But that's the point that we're trying to make right here, is diversification. Protect yourself against market volatility, because real estate, you should always have a portion of real estate. I love real estate. I understand real estate. I know how to operate. I know everything and anything about it. So real estate is such a forefront of the way that I look at retirement. But for another story, concerns
so that's also
that
powerful about the benefits of real estate having insurance, because you were talking about before, annuities, they aren't FDIC insured. Since they don't have that insurance, if something goes wrong with that company, your retirement account is now 0 for that said annuity. For something like real estate, that bad boy burns down, you have a great insurance policy. You could either rebuild or just sell it, or just take the insurance money and run at the end of the day, and just sell the land.
And 1,000%, but within annuities, and just to fall back on annuities, it's not just the fact that if something the FDIC insured, ultimately they win. You need to understand how the fixed income annuity is structured. Why is that? God forbid you step outside of the house and you get hit by a bus, they ultimately win because they get your money. You need to make sure that the structure of the annuity, also some of it is going to your family. That's the beauty of a Roth IRA, or any IRA as a whole. They get passed along to your heirs. You don't have to worry about that. So just keep that in the back of your mind also when you're looking at such things like that. But concerns that we see here at the IRA Club day in and day out, the truth is lack of knowledge. I mentioned most people do not understand that they could even do this, or they may have heard of it, but they don't know how to act upon it. So that's what IRA Club does for you here. We're a full administrator. We're here to educate you. You're assigned an IRA Club specialist. We're going to walk you through this whole process. Me, you, Mark, and the Memphis team and our team, that's what we do here. But the other one that makes me laugh is, am I too old to get started? You're never too old to give Uncle Sam the boot. I just told you live until 80. Did you know that you and or your spouse collectively, if you don't smoke, drink, eat, none of those things about me, because I fail in all categories right over there, and don't laugh at me, Mark, but I fail in every category there. But assuming that you do those, that one of you that will live until 85 years old, believe it or not, is 67%. Keep that in the back of your mind. So you could pass those along, those retirement funds, tax-free or tax-deferred, to your heirs, your spouse, your kids. Risk. Everything's got risk. Every investment's got risk, right? Anything that you do has got risk, but it's taking educated, calculated risks, right? The stock market, we're going through it. We're in the middle, right now. You're going through it right now. So the point that I'm trying to make is taking educated, calculated risks is the way to go. But for me personally, it's just everything and anything. Again, I keep repeating this. It's the control aspect for me. You got to take back control of your retirement. All right. And this is the only way you could really do so. There are a couple other strategies, which I'm more than happy to walk you through. But lastly, these are the things that we also hear is my fiduciary broker, my registered investment advisor said, don't do this. It's too risky. You're going to regret it. That's where the risk factor, right? But that's where the risk factor, Mark, comes in. And at the end of the day, they still have to earn a living. I don't have anything against a fiduciary, a broker, or a registered investment advisor when they're working in your best interest. The problem is, you get attached to them. They become your friends. You're inviting them over to your kid's barbecue, a barbecue, your kid's birthday party. You become attached, and it starts to bother you But if they are a good fiduciary, registered investment advisor, and you say, hypothetical, I found this house on 123 Green Street, Mark, they should say, well, here's an option. You can self-direct it, but you need to find a custodian or an administrator that does this for you, such as the IRA club. That is a good fiduciary registered investment advisor. But remember, it's about fees. It's always built within fees. And the problem is most Americans, 58% of them, don't even know that there's hidden fees on the back end of your employer's 401ks or 403bs. In fact, only 8% of Americans actually know where to find them, look for them, and calculate them. But this is important. I need you to understand these are the 5 most common that are worked within these statements, right? They're hidden fees. They're not expense ratio fees, because as of 2020, the Treasury Department has asked to fully disclose the expense ratio fees and/or management fees, but these are still worked into the statements, and they typically tack up to be still around 2 to 3%. This does not include your expense ratio fees and/or a marketing fee if you have one. All right,
and that's 2 to 3% of the total portfolio value. You got $100,000 in the portfolio. That could be $3,000 per year. Ouch.
You just took the words right out of my mouth. So think about that. For every $100,000 that you have in your current 401k, at bare minimum, they're taking $2,000. So if you have $500,000, they're taking bare minimum 10 grand. And tell me a slap in the face. The market's down 20%. Okay. So if you had $500,000 and it's down 20%, you're down to $400,000. Did they still take their 2 to 3%? Did they take their $8,000?
Oh, yeah.
Of course they do. How do you think these institutions control $30 trillion? And the reasons why they don't like IRA Club, because we're giving it back to the investor. Our fee structure is flat. There are no percentages. We don't want, what we're looking at is, I don't care if there's 10,000, 100,000, or 10 million in your IRA account. It is an annual 175. We are the administrator. We are helping you, making sure that you don't cause any prohibited transactions. We're walking you through the whole process. Do we have checkbook LLCs? Yes, we have those. We're more than happy to open them up. My personal opinion is 80% of the time, somebody screws it up, right? They cause a prohibited transaction. We have them. We could set them up for you, but why do so as us being the administrator? Full disclosure, we make more money at the end of the day. I'm not trying to make more money. I'm trying to help you. The IRA Club is literally walking you through this. Per asset is where we're making our money. It's $135 per investment opportunity. If it is a hard tangible asset, like a house on 123 Green Street, it is $175. There's a lot more paperwork involved, as Mark will tell you. But the point is, it's a flat fee model. We're not making money as you make money. Again, that is the point of this. But let's break down that number. Let's take an actual.
If I just understand correctly, if you go back to those fees, so now we'll go to the IRAs. Yeah, right there. So let's say you have $100,000, you buy one house in Memphis, you have your 175 annual to get set up, plus the per asset, which you said was one, a little bit higher. That's per year, right? So we're talking max $300-400 max, when traditionally we were talking $2,000 to $3,000
per hundred.
Yeah,
per
$100,000. That's
so. But let me backtrack one second. You also have other investment opportunities, right? This only applies to hard tangible assets. But let's just say you have a syndication. It's 135. So and the more investments that you do, so if you get to 5 or more, that actually drops down to $95. So again, I'm not trying to make money on you year after year per investment. We actually give you a discount if you get to 5 and more, because I want to practice what I preach here, right? Amen. That's the name of the game. Amen. Diversification. It seems
like common sense. You have the $2,000 to $3,000 per year in fees on $100,000, or $300 to $400 per year on $100,000.
Look at this chart, Mark. Let's look at this chart. Let's just say, knowing that everything's working against you right now, let's just say you have an IRA with Fidelity, Vanguard, or Schwab, or an old 401k. Let's just start simple. I use everything simple. 100,000. If you heard me say 100,000, that's all I'm using. $100,000 for the next 10 years. So you don't have that mindset of set it and forget it anymore. And the annual contribution is $6,000. Why am I saying 6,000? Because truth be told, the average American only puts 6% into their retirement, okay, year after year. So with that being said, if your annualized rate of return is 10%, I just said to you that IRA Club is charging you $300, right? 0.3% versus Fidelity, Vanguard, Schwab, TD Ameritrade, one of these other 10,000 brokerage firms, or you have a fiduciary charging you maybe, the hidden fees and his 1% or 50 basis points. You're talking about saving in a 10-year span, $93,000. IRA Club is going to save you $93,000. Keep that in mind.
Fees alone, massive.
Right? Think of just the fee structure alone. That's it. But let's take it a step further. Taxable versus tax deferred versus tax free, right? Traditional is tax deferred. Okay. There's the two most common retirement accounts are traditional Roth, right? Traditional IRA, Roth IRA. Traditional 401k, you can do a Roth 401k, right? The only differences are they're all governed by the same set of rules and regulations when it comes to investing. It's just how much can you contribute and when do you pay the taxes? That's it. Deferred, you take the deduction up front and you pay the taxes later as part of your RMD after 72. Roth, you pay the taxes up front and then you pay, and you will never pay taxes on the capital gains moving forward.
Hence I am a huge advocate. Normally recommended.
And it's always recommended because think about it. If your returns on investment year after year is 12%, and let's just say you're in the 30%, 30% tax bracket, right? Hypothetical. By the third year, actually 2.5 years, because we're talking about Memphis and your investments are, and I'm being conservative when I say 12%, because I do know your numbers. I can't see them. So we're being conservative at 12%, but let's just say 12% by the 2.5 year, you have basically paid off the taxes. Everything moving forward for the rest of your life, your spouse's life, your heirs is tax-free. That's why I'm a huge advocate of the Roth. And get your kids involved in your deals. I keep saying that over and over again. I'll give every kid here a free IRA account on me. Just get them involved in your deals. It's a difference of not hundreds, but millions. The earlier they start. But let's go back to this. I'm going off subject. I'm sorry, Mark. I know you love that about me. Taxes versus traditional versus Roth. Let's use your numbers, Mark. Am I conservative when I say 12% in a 10-year span within real estate year after year?
Yeah,
10 years.
Take a all cash purchase, so the cap rate, and then plus appreciation, 12%.
So okay, let's keep it realistic. So 12%, and I know that's an easy number to hit within real estate in a 10-year span. $100,000, same numbers. You're still contributing your 6%. Take a look from your own personal funds versus traditional versus Roth within a 10-year span, right? So if you took money from your Chase account or Bank of America account, you would only make $343. Deferred, traditional, 422 versus Roth, 478,000. This is how you get ahead of the game. These are what savvy investors do. Traditionally, people in the 32% tax bracket or higher. Not only are you making that, so I'm actually just wrote down these numbers, believe it or not. Now you're making within a Roth IRA $135,000 in tax savings on the $100,000 investment, plus IRA Club just saved you $93,000 in fees. That's how you accelerate your retirement account. Jesus, I stuttered. Sorry about that. What is the process like? This is not difficult. This isn't rocket science. I promise you, if you could do this just one time only, you won't even need to call IRA Club anymore.
Get the phone out.
Thank you. Scan the QR code. We built this landing page strictly for Sofa Summit for Memphis. Open, fund, invest. That's it. To open your account, if you like, scan the QR code. It'll take you straight to the landing page. It'll say start my account. In order to get started, you need three things: a government issued ID, it could be your driver's license, state, or passport. Name a beneficiary, always name a beneficiary, and all I need is your social security number. Second, funding, contributions, right? IRA to IRA transfers, old employers plans, contributions. If you're under the age of 50, $6,000, over the age of 50, $7,000. IRA to IRA transfer, IRA Club will do the work for you. So if it's a contribution, IRA to IRA transfer, pensions or annuities, IRA Club will do the work for you. The only thing that we can't touch right now are the old employers rollovers, because by law, we can't touch those. That will change 90 days from now, as Mark is well aware of. But at the same time, we will give you a step-by-step guide, all right, as you open up your application, and then invest. Simple as that. Open, fund, invest. Scan that QR code if you haven't done so already, because, again, I'm going to practice what I preach, and I am going to give you a promo code, and I'm going to waive the first year. Put in the promo code Memphis. Find your investment opportunity. Go educate yourself. You could scan this QR code right now. It'll give you direct access to IRA Club, to me. Schedule a call, because I know everyone's goals and situations and type of retirement accounts are different from the next. All right. We'll never put you in a retirement account that doesn't make sense. In fact, if you qualify for a solo 401k, I'm always going to put you in a solo 401k. Truth be told, only 10% of Americans qualify for a solo 401k. That's why I really don't bring it up that often. But this would give you, when you scan the QR code, you could exchange your contact information with me, and you could take you straight into my calendar link. You could also start an account, go to the website, events, LinkedIn, Google reviews, and everything else that you need is all within that. So, Mark, I hope this was really, really educational for everybody. I'm passionate about it, as you could see. It just bothers me when people can't really do much with their retirement accounts, especially if it's with their current employer. We're just here to help at the end of the day. So keep that in mind.
I love that. Thank you very much. I mean, what absolutely blew me away, and what I challenge every single person listening to the Sofa Summit right now, is if you do have a 401k and an IRA traditionally through the big dogs, figure out what fees and what expenses you're actually paying on an annualized basis. Because like that stats that only 18% of people actually know what those fees and expenses are. And it's a no-brainer, right? Do you want to pay $2,000 to $3,000 in fees on $100,000 traditionally, or call someone like Ramez and just go pay $300-400 per year? The savings are absolutely immaculate, and it's a lot of information, right? But that's the best part about their whole pillars and values, is on education, why he does these. And all it takes is a quick phone call to figure out if it's a good fit for you.
At the end of the day, Mark, it's just because people are, and forgive me, they're just, number one, unaware. They're not educated on the topic. They may want to get started, but the problem is most people that do have these retirement funds cannot identify the investment opportunity. Staring you in the face is what I'm trying to say. So I just can't choose it for you. Ultimately, that's up to you at the end of the day. That's the beauty of a self-directed IRA. One last time, control, control, control.
It definitely is. So if you guys are open to taking more control, please, please, please follow through and contact Ramez. If you need his contact information, you can always reach out to me. I'm more than happy to get that to you. And hope you guys enjoyed this session, and on to the next. Thanks, guys.
Pleasure, everybody. Take care.